Hello, I'm Ryan Lightfoot Amanoff of Fund Caliber, and today I'm joined by Bryn Jones, the elite rated manager of the Rathbone Ethical Bond Fund. Bryn, thank you very much for your time today.
Hi, how you doing?
Now, it's a pretty special day for you. We're coming up to this sort of 20-year anniversary of the fund. So congratulations for your tenure so far. But maybe you can sort of take us through the history pages and tell us how ethical bonds have evolved after the past 2 decades.
Yeah, well, go back to ethical investing really started back in the 1970s and 60s with apartheid in South Africa and the Vietnam War. Our fund was launched, as you say, 20 years ago with a negative and positive screen. So excluding specific negatives like tobacco, alcohol, pornography, gambling, mining, car manufacture, the usual suspects. And then another layer of a positive screen where it had to do good for the environment, society, or good working practices, good corporate governance. And so kind of that was the foundation of the fund, and it was launched to solve this internal solution, which was that we had a lot of ethical money that wanted to invest in bonds, small portfolios, and getting a decent allocation. They decided to unitize it. And so it started out that way. And then, of course, started to grow in popularity. But at first, when I took it over 18 years ago. And at first, you'd walk into a room and, you'd say you'd have an ethical fund and half the people would leave the room. In fact, some analysts, third-party fund selectors excluded ethical funds because they considered that they would be bad performers. And that's clearly not been the case. There's been evidence to suggest otherwise. And I would say, 2008 was tough for everybody. Fund sizes, there was a big drawdown in bonds and the fund size reached about 60 million at that point and then probably nearly halved in value with redemptions and falls in prices. So we had to start again effectively post the GFC. But I'd say in the last 5 years, the demand for sustainable and ethical products has been exponential, driven partly by investors that come into the market that are looking for that, in particular younger generation. I would also say more females coming into the market as well. People with a different conscious approach to this, but also regulation. Regulation is pushing through more sustainable and ethical investing and force investors to invest in this space. And of course, in the last sort of 10 years, we've had the development of sustainable development goals. So we've had a lot of sustainable funds. But, I go back to all ethical and sustainable investing, and I can't really blame anyone for greenwashing because, and that's another term that's come up a lot. And that's because, ethical investing is like religion. We've all got some sort of moral purpose and moral goal, and how we get there and how we achieve that purpose is very different. So whilst we might not have an overall sustainable layer mapped to the UN Sustainable Development Goals, we still have a sustainable approach in what we do.
Thank you. And so within the bond space, there's the quite well-known green bonds that people can invest in, but there's also blue bonds and social bonds. Can you just tell us a little bit more about each of those and what role they play for you?
Yeah, green bonds, they came into a sort of in the last 5 years as well. And now I've just looked on Bloomberg, actually, there's over 5,000 globally, a lot denominated in dollars, euros and Chinese yuan. In fact, in Europe, green bonds, the growth of green bond market is quite significant. In terms of green bonds, do we invest in them? We do in some cases, but we don't just choose them because they're green. The overlay that we get is done by green banks. So we do our own ethical screening. And there might be, for example, a pharmaceutical company which is making their building more green, but they're still doing animal testing inside that building. Well, we're not going to lend them the money. And also in green bonds now, of course, the European Union is allowing nuclear and gas, which is, again, something that we don't consider to be ethical, and therefore we won't just invest in that. So we have our own overlay. In terms of blue bonds, they've been quite minimal. I think Seychelles or the Maldives, some of the islands, small islands, which are obviously aligned with not having lower seawater than rising seawater, have issued some. And we've heard of bonds sort of in Australia, a link to the coral reef, for example, and various, but they're few and far between at the moment. So we've invested in Nature Conservancy, which is in the US, which is doing a lot of work in marine around Belize. And then, of course, social bonds. Now, social bonds have been in existence for many years. In fact, you could probably go back to biblical times and look at social investing. There is a Jewish, I can't remember what it's called, but there is a way of lending out socially as well. That's been going on for many years. And if you think about the early parts of the 19th and 20th, sort of late part of the 19th century and the start of the 20th century, there was a lot of lending around railways and around sewage. The whole sewage system in London, for example, was built around bonds. So they've been around for a long time, but again, have gained a lot of issuance in recent years. And we've seen a lot of social housing bonds, and including the charity bond market as well, which we've invested in, which is also a very small part of the social bond market. And we've invested quite heavily in those areas.
Okay, now moving back out sort of the wider bond market. Bonds have been in a bull market really for the last 20 years since funds been going, with perhaps 2008 being the exception like we talked about. What's your outlook for the next 20 years for bonds?
Yeah, I mean, it's a case of what I would say, the king is dead, long live the king. And that's the new phrase that I've put around the bond market because, bonds have obviously had a tough start to the year. And we've had yield rises like we haven't seen before, well, at least since the 1970s. And if you go back to that sort of phrase that I just said about the king is dead, long live the king, is the bond market's had a tough time, but we're now in a position where yields are much more attractive. For the first time, I did a presentation on this yesterday. For the first time in 5 years, you can now get portfolio insurance and get paid nominally for it, not necessarily in real terms because inflation is quite high at the moment, but it will come back. So for the first time in 5 years, and Paul Brain at Newton, I remember him speaking on the radio quite a few years ago, and he said, if you went and bought a fast Ferrari and you called up the insurance company, would you call them up and say, can you give me some money because I'm driving a Ferrari? No, you would have to pay them the insurance. Right? And so he was saying over the last 5 years, well, it makes sense to have very low yields because if you want to go out and buy a tech stock like Snapchat that's going to fall 50% but could be up 100%, your portfolio insurance you should pay for. Well, now for the first time in 5 years, you're getting paid to do that. So investors now, asset allocators are going, do you know what? Actually, I can stick 80% of my portfolio in equities, but I can actually get paid to have some insurance if I want to do it. And then if you look at the valuation of investment grade securities right now are pricing in the worst case scenario that they've seen since the 1970s. Now, so if you look at what's priced to default, 6% of the European investment grade market is priced to default over the next 5 years. Now, the worst it got to since 1970 was 4% on average over 5 years, so less than 1% per annum. And the actual average for the whole period is 1%. So you're being compensated for taking risk. So again, the king is dead, long live the king, right? You suddenly getting paid. And of course, the other thing about bonds, there's two other things why the king is dead and long live the king, is that bonds now, because they were issued with very low coupons, and we've seen this big rise in yields, that the prices have fallen. So if you remember back to your exams, a 30-year zero coupon bond has a 30-year duration. Well, let's just take BATS 52. We don't invest in British American tobacco, but let's just take that box. It's a really good example. That trades at 50 pence because the bond price has fallen so much because of the duration. Well, what's the recovery rate of BATS? If BATS went bust, would you get 50p back? Probably you might do with all the assets that it owns. So suddenly bond prices have fallen to what they're called their bond floors. So what we would see in convertibles almost. So you've now got this convexity, which means that on the upside, you're going to get a big kicker from if yields fall or spreads tighten. And at the same time, the bonds might not fall so much because distressed debt buyers will come in and go, well, these, we're not going to lose any money on these. If these, we could almost push the business into default and make money. So again, the king is dead, long live the king. And then finally, I would also say that bond prices are now very low. They're actually way beyond 10-year lows, decade lows. And again, that comes back to the fact that now you're going to have this pull to par as bonds near their maturity and amortize. And if you buy a 10-year bond today, in 1 year's time, it's a 9-year bond, and generally yields will fall over time as they near their maturity. So as yields fall, prices go up. So right now, for the first time personally, I haven't held any fixed income in my personal portfolios. I've actually sat on about 60% cash, fortunately. I do think it's a little early to be coming back into bonds. I do feel that we will see some further rises in yields and possibly spread widening if we go into a shallow or even some kind of recession if we get there. But it's a pretty good opportunity to buy some portfolio insurance. And I'm thinking that I might put some of my money in my ISA and JISA into my own fund for the first time in 5 years.
Very interesting. Thank you. And then going back to your portfolio, banks and insurers always played a large part of it. Why exactly is this? And do you see it continuing going forwards?
Yeah, I do actually. Banks and insurers, because 2008 was a rocky time for the banks and the insurance businesses. They only stayed on their 2 feet from basically being bailed out. But if we look at core tier ones back in those days, you take the Spanish banks, CET1s, core tier ones, ratios were 3 or 4%. They had very little capital to wear any kind of pain. They were running like on nitro, trying to generate returns. What we've seen today, for example, I was just looking at the end of Q3 in 21. I just got some stats here on the screen. NatWest is close to 19% CET1. If you take Nationwide at the time, 37.7%. The Coventry Building Society went into close to 40% CET1 ratios. They have a huge amount of capital. And we've seen this when businesses have or banks have had some litigation, or there's been other issues with them, or that they've not generated enough earnings. The dent to their tier one ratio is very minimal, and they're able to wear a lot of pain. And so that's very positive. And so I do get a lot of investors saying, well, aren't you worried about 2008 situation? Well, not, I would be, but less so than I was then. And then if you look at insurers, Solvency II ratios are huge. I mean, we take Aviva with a solvency ratio of 183%. These are businesses now that have very strong solvency, and the yields that you're able to obtain on them are very attractive. Yeah, so we continue to like banks and insurers.
Well, Bryn, as expected, that's been really interesting. Thank you very much for your time today.
Excellent, thank you.
And if you'd like to know more about Bryn's elite-rated ethical bond funds, please visit the website fundcaliber.com. And to keep up to date with all of our videos, please don't forget to like and subscribe below.